Good morning, everybody. Coming in hot today. What's up? What's up? We hour early. We asked Helen's going to be training us, teaching us today. Hopefully, we get a bunch more to jump in. Sometimes when you move the schedule around, it changes everybody's schedule. But hopefully, we get them all. We're going to record this for sure. And Helen, are you on yet?
Helen's in the main room. She's joining in.
Okay, so she'll be here in a little bit. Um, Today we've asked Helen to come on and train on debt elimination program, our DEP program. And Helen, how are you this morning? You doing all right? Why don't you guys get your cameras on if you don't mind, and let's get some see some faces.
Good
So
morning.
good morning. So today is our advanced market training and we do those every Wednesday. Try to mix it up. We haven't had Asher or Chris on in a while, but we'll get those on coming pretty quick. Um, but we've got our own programs here. One of them is called Debt Elimination Program, and Helen does a really good job at that. And I'm gonna have her explain kind of what she does with it. And she does the training during the week as well, later on at night. I don't know how often. We'll talk about that in a minute, but um, this is a chance for you guys to have passive income. Passive income. What does that mean? It means simply go out there and you don't really have to work for it other than just ask the question. Here's the magic question. If How many of you know anyone that can say yes to this question I'm about to ask you? If I can show you how to pay off all your debt in one third of the time without really spending any more money than you're currently spending, would you want to know more about that? That's a real simple question, isn't it? If I can show you, let's get the cameras turned on, guys, as you jump in here. If I can show you how to pay off all your debt, including your mortgage, your car payments, and your credit cards, in one third of the time without spending more money next month than you did last month, would you want to know more? How many of us know somebody that would say yes to that question? All right. Now you might say, "Well, Darren, that's really cool, but I don't even know how to get started. How would I that's news to me. I don't understand that." Well, guess what? Here's the beauty of it. We have people like Helen that works with Agents First, and all we have to do is say, "Hey, Betty. So you said you want to know more about that? Perfect. I've got an expert specialist. I'm going to send you over a calendar link and we're going to send you some information. You're going to fill out a form. You're going to get that to Helen. And then all you have to do is be on that call when Helen is talking to them because guess what? You brought that person in to Helen. And you're going to be the kind of that middleman, but Helen's going to do the work. She's going to run the illustration. She's going to do the work, and you're bringing clients to her, and you're going to make a 50% spread on that. Dude, that's got, and we're going to find out in a little bit. Those spreads are usually pretty good. I'm talking Helen, maybe $2,000 to $3,000, right? Yeah, I'm gonna let Helen talk about that. So I'm gonna pass it off to Helen. I just wanted to give you a teaser about what she does. And guys, it's if you can ask that question 10 times a week and found one, let's say you find 3 to 5 people say, yeah, I want to know more. Not everyone qualifies, but what if you found one person a week for 52 weeks? You make extra $50,000, $100,000 just by asking the magic question and passing it off. Oh my word. Guys, this is crazy, but it's there, but we're not having anyone asking that question. So hopefully after today, we understand better of how to use this program. And guess what? Once you listen to Helen do it 3 or 4 times, you don't have to give up 50%. You can learn to become a master yourself and start doing it yourself. But the program is built as an apprenticeship so that you learn from the pro. And then after a few times, you think, yeah, I might want to be that pro, and we'll teach you how to do that. Helen, with no further ado, I'm going to pass it off. The insurance queen, love this lady. Her and I have been go back a long ways, and we've been working together for a long time, and we love this, love what we do, and she's one of my favorite agents. You all know that. So Helen, I'm passing it off to you, girl.
Thank you, Darren. Thank you. So, what I want to do today and what Darren asked me to do is to get you guys to actually understand the clients that you're looking for, the things that you want your clients to, potential clients to understand about the program, and who is a good fit for the program. Because, like Darren said, it's not for everybody. Everyone is not going to be approved. So, what I'm going to do is I'm going to talk a little bit through the webinar that I do. I'm not going to do it like I presented. I just want you guys to understand what we are looking for and some of the questions that you can actually ask when it's time for you to start doing this, implement this into your business, and start looking for these clients that pays really great money.
Love it.
So let me share my screen with you guys, and as I'm going through, just stop me if you have any questions. Okay, hold on, I'm working with two screens over here. 1 second. Sorry, guys, I just set up a new screen and find time for me to be trying to learn it. Okay, here we go. All right, now let me share. I got it open. So the first thing that you want your client to understand, and my screen should be coming up right now.
Yeah.
Can you see it, Darren?
Well, it just says Helen. There you go. I can see it now.
Okay. So this is one of the things that I try to make sure that my client understands. And this is a question that you can lead into with actually asking this. So I'm going to be looking out, but I'm looking at another screen. So would you rather have $1 million today or a penny that doubles daily for 30 days? Now I want you guys to put in the chat option one if you rather have $1 million, or option two, if you rather have a penny that doubles daily every day.
That's a great question. I want to see what people are saying here.
Okay. Right, we have some multiple things going on. I get a lot of people that will say $1 million, and the reason is that's a lot of money. When you're thinking about the penny, it gets kind of boring. You think a penny that doubles daily every day, nah, that's not going to give me any money. But if we look over here, and you see, day one, you're going to start off with a penny, of course.
Yeah.
So day two, you got 2 cents. Of course, I'm not going to go through all 30 days, but what I want you to do is take a look at day 20. So now we're at $5,242. But if we look over at day 28, now we already reached $1.3 million, and we still have 2 more days to go. So a penny that doubles daily every day for 30 days is going to get you $5.3 million. So now for my people that said a penny or $1 million, I know you're rethinking your answer. So why do I ask this question? This question leads up to what infinite banking is really about and how your client is actually getting the cash value in a policy. So it's called compound interest. And compound interest was created by Albert Einstein. And he said, those who understands it, earns it, and those who doesn't, they pay it. And that's a very, very interesting statement, because as we go through it, you will understand that if you don't understand how this compound interest works, you can actually be the one on the opposite side that's not actually getting a compound interest. You're paying it through your debts, because your debts also compound interest as well. So what I want you to look at is infinite banking concept. I want you to understand what is the infinite banking concept. And that's what is used for when we're talking about debt elimination. So we have this guy here, R. Nelson Nash. He is the one that actually created this. So he created a book called Becoming Your Own Banker and also Building Warehouse of Wealth. I've read both of these books. You can do them in about 3 hours, cover to cover. What I do is when I meet with a client, after we go over everything, I have an audio of the Becoming Your Own Banker that I actually send to them. I tell them that they need to go on Amazon. You can get both of these books on Amazon for under $20. So you're going to need the book to follow along with R. Nelson in the audio to actually see the illustrations that he's talking about. But I can also share that audio with you guys. And these are two very good books that you want to understand. Because like I tell all of my clients that I meet with, I don't want you to believe everything that I'm saying. I want you to hear from the person who actually invented it, the person who actually brought this to life. So this is why I make sure all of my clients get this. I follow up with them and make sure that they did get it, they are reading it, and if they have any questions, so also follow up with me. So now when we think about the infinite banking concept, what I want you to understand is it's not a product, it's a process. And one of the main things that I like people to understand is that this is not a get rich scheme. It takes time. It takes time for the compound interest to actually build in the policy. And I don't want them to look at it as a product. So what we're doing is we're using dividend paying whole life insurance policies from mutual companies. And I'm going to go a little bit into mutual companies, but we're using companies like Lafayette. There are some other ones out there. I think Darren said Forsters also does it. We have Mutual Trust, and these are companies that has been around for 100 plus years, and they have not missed a dividend payment, even through all of the worst times, the Great Depression, 9/11, the 08 market crash. Everybody else was scrambling and losing their minds, but life insurance did not take a hit on that. Dividends still coming in, people still making money in their cash value in their policy. Always a dividend being paid. So I said I was going to talk a little bit more about the mutual companies. The only thing that I want you to understand when we're looking at stock companies versus mutual companies is that the stock companies, they're pretty much just for the stockholders. They're making money for the stockholders. The dividends are not the dividends are taxable. But when you're talking about mutual funds, you are the policy holders. You are the stockholders. So you're making money for yourself. You're getting paid the dividends. And guess what? The dividends are not taxable. They are tax-free. And as you can see, as I told you before, that dividends has not been missed. So you're guaranteed to get that money. But by law, we have to say that dividends are not guaranteed because as of right now, never miss a dividends, but we don't know. So you have to assure the client that this is something that can happen, but it has not happened. People have been receiving their dividend payments. Any questions before I move on? So what I want to show you guys now is actually some famous people who is actually using the infinite banking concept. I'm not going to go through all of these. I'm quite sure that you guys are familiar with half of the people that's on here. So the first one I want to talk about is the Rockefeller family. They're the ones who are using this, and they put a policy like this on every one of their family members when they turn 14 days old. They are getting a policy. They are using these policies, putting them inside of a trust, and everything that this family is doing, they're using the cash value in their life insurance to fund businesses, do whatever it is that their family needs to do. The Rockefeller also has a book that you guys can get. Walt Disney, this was one that actually I didn't know until I actually got into this. Walt Disney used the money, the cash value inside of his policy to actually buy the land for Walt Disney. That I didn't know. And then if we look at Ray Kroc actually, I don't know if you guys know who this is, but he's actually the one that bought McDonald's. He was trying to borrow money when it was a time when none of the banks, nobody was lending out money. And Ray Kroc went to his life insurance policy, borrowed the money from his whole life policy to actually purchase McDonald's. Now, these are some other people on here that you guys can research for yourselves, but I'm not going to go through them for time's sake. So now I want to ask the question, where do banks put their money? Do anybody know where banks put their money? Anybody can answer that question? I have a lot of silent people today.
Bowling.
And funds.
They put them into life insurance, whole life policies, mutual funds.
That's correct. And what we are trying to do is get people to understand that what the banks are doing with your money, you can do the same thing. So if we take a look at this, bank-owned life insurance, which are called BOLI accounts, and I'm quite sure that you guys see your bank on here. If not, there's another page I can go to. So the banks are actually, this is one of the ways that they're using money. Of course, they do real estate and different things, but this in real estate is one of the main places that they actually make their money from. Mm-hmm. So what I'm going to do is I want to share the screen with you guys. Fractional reserve banking. Mm-hmm. So when we think about fractional reserve banking, I want to first give you an example. When you put $1,000 in the bank, 10% of that money is going to go into a reserve account. The other 90% of that money is going to be used for the bank to do what this slide here is showing you. Mm-hmm. So just remember, if everybody put their money into the bank and get their money out the bank, then what? The bank has no more money. So the bank have to make money for themselves. And this is what they're doing. They're using your money, that other 90%, and they're lending it out for mortgages, for car loans, for home modeling, debt consolidation. And the banks, we're giving the banks 500% in interest. So if you look in the middle here, right now we have the banks. How the banks are making their money. They're getting a spread off of those liquidity interests that they're actually charging a client to actually get a mortgage or get a car loan. So once they are paying that back, the spread is what the banks are actually getting. So they're making money off of other people's money. So I want you guys to think about that when you have a client that has a large amount of money parked inside of a bank, you know, or you may have money parked inside of the bank. Just understand that this is what the banks are doing with your money. But now I want to show you on the next screen. Actually, you see in the middle, we have a contract. Now, the other screen, we had a bank. That contract is a participating whole life policy, right? So now, instead of the banks getting the spread, the banks getting the money, now who's getting the money? The policyholder. So when we are teaching clients how to do this is what they're doing. They're taking back control of their money. They're taking back all of the interest that's being paid to banks, to lenders. Now we're teaching them how to take back control of all the interest that they're giving away. That's why in the beginning, it's very important that they do understand compound interest and how all this works, because that's the main piece of it. You want them to understand this. So if you look at this, if you're doing it this way, instead of the banks getting that 500% interest, what it's doing, it's staying inside of your family now. So now when we're talking about the infinite banking concept, I want you to think about it. It can be used like a Swiss Army knife. And when we say that, it can be used for all of these different types of things. So first thing, we're definitely talking about debt elimination, right? So you know that when we say eliminate, that means it's gone. So it's gone for good. It's not coming back. So when we talk about eliminated debt, we're not talking about refinancing. We're definitely not talking about debt consolidation either. And because none of those things actually truly eliminates the debt, it comes back and it never was eliminated. So now when we're talking about eliminating debt, we want our clients to understand that we are not wanting you to get it confused with debt consolidation with investment, because it's definitely not an investment account. And we also want them to know that we are not here to compete with their IRA account, their 401k, their what would you call a guy, their brokerage guy. We're here to compete with their checking account, the account that they actually paying their bills from. That's who we are competing with, because we want to teach them how to do this themselves, pay this off, gain that interest back. So that's one of the first things, infinite banking concept, one of the features inside of it. Then we talk about children future planning. Okay, Helen, how does that helps with children? If you put a policy like this on a child, you can actually use this when it's time to get those braces when they turn 12. Now you have somewhere to go get that cash value out and pay for those braces. Now you have money to go get cash value when it's time to pay for college, to buy that first car, to put maybe a down payment on their first home. So that's how we can use it for the children. Then personal financing, of course, like if you're purchasing a home, you want to go on a vacation. So you have this money inside of your cash value policy where now you're in control. You're the owner. You don't have to fill out a loan application. You just get this money when you need it. So then we talk about business finance. I work with a lot of business people, and I teach them how they can use this to actually use it as operating costs, as when they want to purchase, they may need something in the office, let's say a new printer or something with the business equipment. They actually can use this for that reason. Real estate agents, they can use this to leverage their money. They flip a home. If these policies are set up correctly, they can put this money inside of the policy and they can leverage their money when they need money, because they're not always selling policies. So now they have somewhere that they actually can get money from when they need money and when they're not selling homes in the market. So we had emergency funds. We have wealth transfer, and that's when we're talking about the Rockefellers, how they did the wealth transfer, and also keeping taxes away from your wealth, and that's with estate planning. So it's why we call it Swiss Army knife. It does a lot of things. So you may have a client that doesn't need it for debt elimination, but I for sure you there's something on this list that your client can actually use that infinite banking for. So we already talked about this. So what are we using to do this? We're using a properly structured and engineered life insurance policy that provides more than just a debt benefit. So before I move on, I want to talk about that, because what I have now been sharing with my clients is that there's two different policies that you can have. You can have a debt policy and you can have a life insurance policy. A debt policy is one that you're paying your premiums on, your final expense, and you just paying it. You pass away, your family have a debt benefit to take care of your final expense. Then we have what's the life insurance policy. That's a policy that you can use while you're still living. That's these type of policies that we're talking about, a properly structured engineer policy. And we have a lot of clients that they don't know the difference. Believe it or not, they don't. They have a lot of clients out here that do not know that you can actually use a policy to pay off debt, to do a lot of those features that I just talked to you guys about. So those are the main things that I want you to understand. But what we are talking about is debt elimination. So we're talking about teaching clients how to pay off their debt, and 2 to 3 times faster by actually using one of these policies, including their mortgage. And that blows people away, because what you don't want to tell people is, I want to show you how you can pay your debts off in 10 years. you know, or 8 years. You don't want to tell them that, because then if that doesn't happen, then they're coming back at you. So you want to use the verbiage, let me show you how you can pay off your debt in 2 to 3 times faster than what you're already doing. Any questions?
And
This is so
really,
good, Helen. This is so good.
Thank you. Thank you.
Helen,
So
this is all
once,
depending on the ability or the I guess we're teaching the clients right how to do this the right way. So it's all about changing the way they do things. If you keep doing things the way you've been doing them, you're going to keep getting what you've been getting, right? So it's about changing your mindset of how you're doing things and the money that you're putting in there when you pay off a bill. So I want you to kind of explain how this process works, because we do, and I know you said we're going to go in depth, but we do need to know the understanding of a whole life participating whole life policy, and that when you use that money and you take it, then let's say we're doing the snowball and we're going down and we're knocking off payments. That client has a responsibility when he knocks that payment off. What's he going to do with that money, and how did that? So, kind of explain that process to us.
okay, yes, I was going to get to that. That's
Okay.
actually was the next slide. After this, I'm
Perfect.
going to change my screen over. But I just want them to get the process of how the whole thing, goes, Darren.
You did a great
So
job.
you're going to
Helen.
show them a side-by-side report. You're going
Okay.
to show them 2 reports. In order for you to be able to do this, you're going to have to show them the data action report, which is in Agency Rocket. You're going to have to show them their bank, and their bank is going to be their participating whole life policy. I like to refer to that as their bank and not a policy.
That's right.
So what are the things that you're going to be getting from them? You're going to have to ask them, who do you owe, how much you owe, what's the interest that you're paying, and so on and so forth. The minimum payment if you're making any overpayments. One important thing
right,
before
Helen?
I show you guys the illustration that I'm going to show you is this is not a one size fits all. Everybody policy bank, everybody debt action plan is totally different. I do banks as small as $300 on up to, I have done up to $2,500 a month in premium. So when you see this, don't think that, oh, my clients can't afford this, because sometimes you have clients that's actually using money that they're already overfunding a policy with. So I want you to take that out of your head and don't think that these policies are too expensive for the type of clients that you see. Until you give them that debt action plan report to fill out, you're not going to know. So I'm going to stop sharing, and I am going to share my another screen with you guys. So what are you guys thinking so far? Thinking this is something that you can do?
I think when they see this next slide, Helen, they're gonna the picture will be painted a lot more clear. They need to see this next part to understand that. But you're right. Once you understand, you see the illustrations, Rand, you begin to say, "Oh, I get it." So I know that they can. So comments. Anybody have any comments of what you've seen so far?
Good information. That's all I can say. Very good information.
Thank you, Ivy.
Okay, Darren, let me know when you can see my screen.
Okay, you're getting ready.
Okay.
There you go.
So on this screen here, let me make it a little bit bigger. This is a company that we use. We use Lafayette Life.
Yep.
And this here is a husband and a wife policy that I did.
Okay.
The wife could not qualify for the policy, so we put it on the husband. And those are some things that, you can do. So you do not have to go through all of these slides, because what you're going to do is you're going to confuse the client. So what I want to first show you is how you're using and how you explaining this to the client. Now, this client here is paying $1,500 a month, and you can see they do have a debt benefit of 108,000. But I like to tell my clients that you're looking at that as a bonus because this here is not debt focused. It's focused on the cash value in the policy. So I also explained to them the guarantee side and the non-guarantee side. So the only thing that I want you to understand is on this guarantee side, the only thing that's different is it's not showing you dividends. That's the only thing. So you still want to insure the clients even without dividends. Oh, I'm on the wrong year. Okay. Even without dividends, if you look, in year one, it was 78.80, but in year two, the cash value still growed without any dividends. So that's showing you that that compound interest is still working if that client do not get any dividends. This is where you can assure the clients that this is not an investment account because you're going to make money in this policy, not make money. Your cash value is going to grow in this policy regardless of what the market is doing. You're going to grow cash value in this policy. But I want you to look on the other side, and this is the side that I use. The non-guarantee assumption. Only difference is you see now it's a dividend payment. So now there's dividends that's growing inside of the policy every single year. At the end of the anniversary year, that's when you receive the dividend payments. Dividend payments are different for everybody. It's according to the amount that you're paying. It's according to, how much dividends that the company is having to divide up. So there's a lot of things that goes into play. You don't want to explain that to the clients. You don't want to get them all confused. So I want to scroll down to year 10, where you have $163,036. Let's just say your client wanted to borrow $10,000 to pay off a loan. What does that benefit come into play is instead of the insurance company giving you the $10,000 from the cash value, guess where the $10,000 is coming from? The $10,000 is coming from the debt benefit. And this is because the insurance company needs leverage. If you don't pay this back and you pass this away, all the company's going to do is they're going to subtract the $10,000 from the debt benefit before giving your beneficiary the money, from the policy. So, but the beauty of this, even though you took a $10,000 loan off, so that means technically you have $153,000, right? But guess what? When we talk about uninterrupted compound interest, this is where the beauty comes in. You are still getting compound interest on that $163,000, even though you took out $10,000 off. So you compounded on the money that's in there, even though you're still getting loans out of the policy, you're still getting uninterrupted compound interest on the money that you have inside of the policy. That's one of the main things I want you to understand. So now I'm going to show you how we're going to use this bank, which is your policy, to actually pay down the bills. But before I move on to that one, I want you to understand is the numbers that you see here inside of this cash value. This is only if this client make their $1,500 payment every month, do not take any loans, no activities on the account, no extra money is going into the PUA. This is what it's going to do. So now let's look at the debt action plan. Did it switch over?
Yes.
Okay. So this is a debt action plan that every one of your clients will receive. And it's going to be structured for your clients with the information that you're actually getting for the clients. This client, we're putting $1,500 a month. I was able to save them $16,052 in interest payments, and they're going to be debt-free in 5 years and 11 months. Doing it their way, now they were actually making overpayments because this husband and wife, they're really tired of debt. They really want to pay these debts off. So they were making extra payments to their lenders. So doing it their way, with their $363,000 that they owe, they were going to be paying off this in 11 years and 1 month. But now on a new debt action plan, and using their bank, they're going to pay this off in 5 years in 11 months. Do you think your client will be smiling if you show them something like this?
No doubt.
So this is where we get the inefficient dollar amounts that you can actually use. So this client here in overpayments, they were paying $1,373 in overpayments. So see why this $1,500 payment is not a big deal for them, because they are already doing this. This is not any extra money that they had to come up with. They had insurance payments of $44.84. So what they told me was, Helen, let's just round that off to $1,500, and that's what I want to fund my bank with. So on this page is what they're currently paying. These are the amounts they're paying. If you can see here, these are their minimal amounts that they're paying. But then if you look here, this is what they're actually paying. And you can see all of the overpayments that they're paying. Like their Bank America was $161, and they were paying $350. Same thing with their Bank of America, $237, but look how much they're paying, $700. So this is why you have to get your client to fill a form out. You looking at it, you're going over it, you're asking your clients, about these bills. You want to make sure that these overpayments is something that they are doing every month, not just, okay, every 6 months, maybe I put an extra money. No, you want to make sure that they are doing this every month, because you don't want to come up with a payment that they cannot afford, because this is not something that they are used to doing. So if I would not have seen this overpayment, I would have never asked this client, hey, now it shows me that you can make this amount of payment. No, I would have dissected that form and then came up with a reasonable amount to fund their bank with. Do that make sense to you guys?
Yes, and Helen, what we're going to do is we're going to tell them that they're going to stop overpaying.
Yes,
and now
exactly.
that overpayment, and we're going to move it to this. So you're not spending any more money than you were spending. We're just moving the way you're spending it, changing the way you do things.
Exactly, Darren.
Gotcha.
So now on this next page, it's going to show you side by side when they doing it their way, when they were going to pay the bill off, and doing it on new way with the debt action plan. So let's look at their JCP. We have their balance, their interest rate, their monthly payment, which is $126, just like Darren said. We stopped all of the overpayments because that's the money that they are using to redirect into their bank. So this $126, the current payoff date was April 1st of 2027. So now their new payment date is actually this month, January 1st of 2026. I had a meeting with this client on yesterday, to talk to them about getting these things done. So the time left was 5 months. They're going to take this 126, they're going to redirect this into their next payment. So now instead of paying 126, they're now going to be paying $226 that they're going to redirect into their payment. So this is how it's going to snowball down, because they're not going to say, oh, I'm finished with that bill, I have some free money. No, that's not how it works. We're going to redirect that money so that we can pay those bills down. We understand that? And they're going to do that all the way down until the mortgage. But the beauty of this is you're in control. It's your turn. You're paying it on your terms. If you don't want to redirect, and Darren, I'm just being honest. Yep. If you have a client that have something else that they have to do and they don't want to redirect all of it back into the bank, just so long that they are putting something back, just so long they are repaying it back. Because what we want is the activity, on your policy, paying a loan back, paying more money to the PUAs. As long as you have some type of activity on it, your cash value in your policy is going to grow. Right. So I just let clients know that, because we have rainy days that come up, but you just make sure you put something back into the policy. So now if we move down a little bit further, I always ask this question. So Ivy, let me ask you this question. Let's just say you were the client and you had $293,000 in your bank over the time. You made these payments, you paid off all of these bills, how much would you have left in your traditional bank, which is your Bank of America, Chase? How much money would you have left?
293. I don't know. I don't know how to answer it.
If you paid all your debts down and you paid this $293,000 down, and let's just say you had over $300,000, you paid all your debt down, so you have a little bit of no money left because you paid your bills, right?
Right. It'd all be directed to my own bank. The 293.
No, we're not talking about your bank now. We're talking about your traditional bank checking account.
Yeah, you just spent all your money, but you hadn't got the money left over because you've spent all your money towards debt, but you have nothing else other than that.
You have nothing left. And that's what happens in a traditional bank.
Right.
And what you did was you gave up the ability to gain all of that interest back into your bank account.
Okay.
Yeah.
You got it now?
But doing it, your money, and the bank invested your money. Why would you not do what Helen's talking about and put that money in your bank so that you get all that? You remember that 500% that they talked about the bank?
Yes. Yes.
$293,000 to invest over all this time. What if you had that $293 and it was putting into your bank and you were compounding interest off of your money? And that's what Helen's showing us here.
Right.
Yep.
No, I understand.
And if you continue to do this to fund your bank, pay your bills off, in over 20 years, this family is projected to have almost $1 million in 20 years. And then in 30 years, 1736, because what's happening is even though they were paying these bills off, the money still was compounding interest for them, and they still putting money into the banks and not into a traditional bank because now they understand how this works. They understand how putting their money inside of their bank, which is their life insurance policy, can actually grow their money. So why put my money in a savings account? You know, at least a large portion of it. You know, so that's pretty much what I go over with the clients. But that's what I just wanted you guys to understand, that when you're looking for this client, don't, think that they can't afford it, because you never know how much somebody is paying over on their bills. And you won't know that until you ask these questions and it comes up. You just have to figure out a way that you're going to actually, implement this into your process with selling policies to your client. Alan, I'm gonna get to you in 1 second. But what I do want you guys to know is a rule of thumb is, even if they are not making any overpayments, let's just say you had a 58-year-old, they didn't make any overpayments. I put a zero in the way that I was taught. I put a zero behind it. So that's $580 that will actually help that policy to grow the cash value in it. And I tell them, in order for this to work, we at least want to put a zero behind your birthday, behind your age. And that's how I come up with a number if they are not making any overpayments. And if I'm looking at their wages and everything, making sure that that's something that they actually can afford to pay, because you don't want this charge back. This is a hefty charge back. So you want to make sure that you are doing this correctly. And not look at the charge back and want the big charge back. So, yes.
They've got to understand the meaning of it, that they're trying to pay off debt, right? And so that you get them, once they understand, they buy into what they're doing. So don't oversell anything. If you do anything, you undersell it. I love the concept of putting a zero at the end of their age, because as you get older, you got a shorter amount of time to get that money built up. If you're 38, you can let that thing build for a while. But if you're 58, you want to retire in 7 to 10 years. You don't want to work forever, and you want that thing to start building faster. But Helen, the incentive is, if I'm older, I get that, and I'm going to find a way to get that money. Plus, as you get older, you typically have more resources. But I love that concept, adding a zero to it. If they're just going across the board, you find the money. If you really understand what you're doing and you want to do that, one of the questions we always ask is, what would retirement look like to you with zero debt? Well, if you're 58 years old, that question is more important to me at 58 than at 38. Because at 58, I'm thinking, dude, I don't want to work till I'm 78.
Huh.
I'd like to retire when I'm 65. Well, that means I got 7 years to do this. I'm going to find that zero and I'm going to figure out how to do $580, a month plus what I'm doing. So,
Okay. And
Oh,
also I want to let you guys know that when you're doing these policies, you're not asking for no banking information. That's the beauty of it. You are strictly submitting a policy because it takes some time because they all go to underwriting. I'm sorry, they all have to be fully underwritten, meaning they have to get blood, urine, and all of that done. So that assures the client that, hey, let's just get this in. And once I get the approval, then I'm going to call you back and I am going to let you know, hey, it's been approved. So now let's get your banking information and now give me a date that you want this to come out of your account because these premiums are too expensive for you to be getting their banking information now and then it gets approved and you've been with this client past a month and now it's almost a month and a half and they got this big payment coming out of their checking account. You do not want to make a client mad like that. So you want to ensure them that no money is coming out of the account. Alan, I see your hand up.
Yes, thank you. I missed the first little bit of your presentation, but if I understand it right, they agree upon an amount to put in the policy each month, and then they're doing the snowball effect, which you showed by putting the next, minimum payment when they pay off one debt. And so, is the client taking out loans at certain points to pay off this certain debts, and then when they do take those loans off? Out, then when they're debt free, like in this case, just under 6 years, are they continuing to use some of that money to pay back those loans so that they're at zero?
Yes.
Give me
So
the quick nutshell.
I'm glad you said that, Alan, because I left that part out. So what how do I explain this? So I get some of my clients to say, if this is my money, why am I taking a loan out and not a withdrawal? So what I want you to understand, if you take a withdrawal out, then what happens? Uncle Sam has his hand out. So now that money becomes income. So now you're going to be taxed on that money. But now that you're taking a loan out, Uncle Sam can't tax a loan. So I wanted to let you know that first. So Alan, yes. So they're going to take a loan out and then they're going to pay the loan back. So when we are doing these policies, it's a lot of moving parts. So it's a lot of times that you're actually meeting with your client. So I actually meet with them. I show them how you're going to take these loans, how it's going to show up on your client portal. Because once you take the loan out, you're going to see a button where you actually can pay toward the loan, pay toward the PUA, also make your monthly payments. So it's a lot of moving parts, and they're actually going to do that. And another thing that I wanted to let you know, and Darren, I don't think I mentioned this part to you, it can be done different ways. So that's why I say every client is different. You can do the snowball effect, you can do the avalanche. It's what your client actually, you looking and you talking with your client and you seeing what their goal is and you actually looking at their money situation. Because I have a client that they're not paying the extra money to their loan. They're actually snowballing the money. So let's just say that next bill, they're going to take that 140, and let's just say their next bill was $200 to pay it off. They're going to put that 140 with that so that they can pay that bill off first. Then I have a lot of clients who is paying that money actually back to the insurance company, and they're getting a spread on the money. So it's a lot of different ways. So not unless I'm talking with that client, it kind of can get confused. It can get confusing a little bit. So, but I just wanted to answer Alan's question and to also let you know that there's different ways that you can do that, Alan.
Okay, thank you. And then when, in this instance, when you're showing that example for that client, when is the first loan taken from the policy to pay down the debt?
So
And
you're
it'll
going
show
to
you.
look at the debt action plan,
Yeah.
because you
Mhm.
definitely cannot do this without the debt action plan. I'm going to pull it up for you real quick.
What's really
Again,
cool on that
so that
debt action plan is it's going to show you to the day that Helen. So Helen's going to be calling these agents, our clients, on these days. It's going to have a day. It's going to be like March the 1st, and she's going to call them. You've seen the one of these January the 3rd or whatever, and she's calling them up and saying, "Hey, you looks like you got enough in your account now to go ahead and pay off this one bill. Why don't you go ahead and take care of that?" And
yeah.
then they would call the insurance company, ask for or fill out a form, ask for that $1,200, whatever it might be, and they'll put that money in their bank and they go pay the debt.
Mm-hmm. So, Alan, if you look here, and what I teach my clients, and everybody does this differently, but this is what I find that's helpful for my clients. I have them to actually open up when we setting this up, I tell them before it gets approved and everything, if you would get and open up a separate account. Because what I want them to do is go back years from now and see all of the deposits that was made, all of the bills that they paid off is all underneath one account, not their regular checking account where they have everything coming out of. So if you
Mm.
look at this, Alan, I spoke with this client on yesterday. I had the meeting with them, went over everything, and let them know where they get the form from. They can either call up Lafayette or they can go in their portal, download the form, fill it out, send it back to Lafayette, and then they will request a loan for $3,100. Lafayette is going to, approve the loan. All the loans are approved, of course, because this is their money. And they're going to put the money into their account in 3 to 4 business days. And then once they do that, then that extra button is going to pop up for them to start making the repayments back into the loan. I mean, to the
Okay, from
policy.
their Lafayette portal or from
Yes.
this agency Rocket?
No, Lafayette Porter. The loans are coming from the insurance company.
Yes, yes. Okay,
Mm-hmm.
okay.
Mm-hmm.
And how long have they been putting money into their policy at this point?
This client here started we started, I think it was back in October, I want to say.
Oh,
I think it
wow.
was
And they already have
October.
enough to put in
Yeah.
$3,100 loan. That's
Mm-hmm.
awesome.
Yeah.
Yeah, doesn't take long.
I started with them in October. They were approved in November. Yep. They were approved in November.
And pardon me again if I missed it, but give me the basics of the policy, how much they decided to put into it a month to keep it growing, and then what was the face value face value and target and things, because
Okay,
I'm
so if you look
unfamiliar
at
with
this
whole life.
page, they were making overpayments. So there's a form that you're going to give to your clients to fill out.
Hmm.
And this is how much they were overpaying. They were overpaying
Wow.
$1,373 in their bills. So
Wow.
after we talked and everything, they just rounded it off to $1,500. So they didn't
Okay.
have to come up with no extra monies. And just like I was talking about before, if you have somebody
Hmm.
that don't have money to redirect into a policy like this, you're just going to put a zero behind their age.
Sure.
That's how
Sure.
it works. It works better.
So your $1,500 was your monthly premium for that?
Yes.
Okay.
Mm-hmm. Yes.
Awesome.
So
And
that's
this
why
is
you want
enough
to make
for
sure I'm always asking the client, okay, you do know that this $1,500 is coming out of your account every single month to fund your bank. So are you sure? Because I don't want you to have to not make this payment or let this policy lapse. So do we need to go down a little bit? It's okay to have that conversation with your client. It actually
Sure.
makes them feel a little bit better because they know that you're not trying to get a big commission off of them. So
And
I'm
what's your
asking
strategy?
them, do you want to go down?
That's awesome. What's your strategy when you create the policy? If you know, like it's $1,500 that they can put into it, is it like with an IUL where you solve for the minimum amount of death benefit, or how does that work?
No, that
no.
benefit doesn't have anything to do with it. As you can see, when I did show the policy, they only had like I think it was 130,000 for 1,500. Yeah, no, 108,000 in face value for $1,500 a month. So that tells you right there that these type of policies is not based on the
Basement.
debt benefit, because $1,500, and that's a whole nother training, how this is actually broke down, how that $1,500, because part is going to the PUA, part is going to the base. You can structure these in 60-40 set 60-40, 70-30, whatever is good for the client. So that's a whole nother training. That's a whole nother training.
And tell you what we're going to do, we're going to have Lafayette Life and Foresters come on and do some illustrations and demonstrations of how to run these. So that's on a whole nother cell.
Yeah.
We'll try to get those plugged in here with this next month in February for sure. We'll get on some product training and kind of teach you how to sell that and what it looks like. For you guys that's been doing IULs are great, but these are going to be more simple. The difference in structuring this and IUL is a lot different, and these are going to be a lot more just cut and dry. It's simple. I know that look confusing, but just understand this. You've got professionals here that do this, and we can turn those over to Helen if you choose to, or myself. I'll be doing these as well. But there's people that we have professionals in place that can do this for you at the beginning, and then let them do it. You just pass it off and then watch and learn and listen, and then pretty soon you can become that expert. And that's what we're doing here. Helen, what would you say your average commission so far? $300, $1,500, and probably in that middle range. Would you say closer to $600 or $700 range a month?
My highest commission has been
I guess annual premium. So don't worry about commissions right now, but when we're looking at APs, our monthly premiums, $300 a month. Is it probably your low side?
And $2,500 was my highest.
Okay. So would you say your average is running probably $800 a month on average is what people are doing, or $500? I'm like, what's a good, when then you got to try to figure out what they can make on this.
My average is running from at least about 8 to 1,000.
Really? So guys, I want you to think about what you just said. $800 a month to $1,000 a month. Now, if you're writing a whole life final expense or a mortgage protection, you're probably used to getting $80 a month, or maybe $150 a month if you're doing mortgage protection or some bigger whole lives. Not 800, not 1,000. So you look at the difference. We almost 10x'd off of one client sitting. Now, does it take more time? Heck yeah. It's going to take 2 or 3 appointments. It's all right. You literally have 10x your investment. So if you were used to making, if you, and I don't want you to just stop what you're doing and do that, but just throw it on the side. But you think about it. You might make $1,000 on an $80 a month policy, on commission, or $100 a month policy. If you're doing an $800 a month policy, those commissions goes up to more closer to $10,000, $8,000. Well, if you're passing it off to Helen and you do an $8,000 policy and you get 50%, you make $4,000, and all you did is ask a magic question and sit there and learn how to do it. Who could make an extra $2,000 to $3,000 to $4,000 a month or a week just by passing it off to Helen?
And hey, Derek, another thing is you finding extra money. I closed an annuity, I think it was last month or the beginning of this month. And I found when they fill that form out, you find out different things. Like I found a 401k that was just sitting there because they no longer worked at the job. That was for $49,000 annuity that I done. And then I just submitted one for Gail, and we worked on, and the young lady, she had $30,000 sitting in the banks. So we were able to give her husband an annuity. Gail wrote the annuity up on the husband because he couldn't get qualified. So now he has some type of retirement. So you're finding extra monies. You're finding annuities. You're finding different things. Like, you'd be amazed, and you may look at a client and don't think that, that's going to come out of their mouth. Oh, I have $30,000 sitting in the bank.
Yeah.
Yeah.
And Helen, the foresters, they do have a simplified issue now on a participating life up to I can't remember how much, but it was like 2 million or something. But they do have a simplified issue, so that's going to be nice. We'll be introducing that to you very quickly. I've got to get that when we get done today. I'm going to call foresters and figure out where we're at with that. So guys, good stuff, good training today. Let's open it up for questions, and this can be all over. Let's look at chats and see what we got.
I have a question.
Yeah, go ahead, Ivy.
If a client cannot qualify because of health reason, can you write this on somebody like a grandchild or a child or someone else and make it work for you if you are the owner of the policy?
You can. It has the first way I was taught. We weren't thinking about that, but it's a lot that comes into that when you put the grandchild on, because you got to look at that amount of insurance that you're actually doing. The company is not going to allow you to put a lot of insurance on that child, if that makes sense to you. And then if you do it,
A grown grandchild.
Oh,
maybe 50.
a grown grand. Let me tell you this example that I had. I had a client that wanted to put it on their son because she couldn't get qualified.
Right.
We were able to do it. The son was 27. We were able to do it, but she could not be the owner of the policy because they figured that that's an adult. So why are we making that adult another adult the owner of the policy? So that's something else that you're going to run into, and they may not want. That's a lot of money, cash value going into it. And then if you have that adult child that actually can see this, you have to make sure that you have somebody that, responsible, and that's not going to be calling up the insurance company behind your back to get some cash value. So it's a lot that goes into it.
Okay. That's what I need to know.
And we will have reps associated with Lafayette Life and Foresters. And if we need to have those type of questions we're just not sure about, we will get answers for you. Okay, so good. Anybody else? Helen, if they wanted these forms, and let's say we have somebody, we want to go out today and we want to ask that magic question, what would that look like, and how do we get that to you, Helen?
You say how would that look like?
Okay, let's say we got 20 people on here today. All 20 of these went out there today and they asked 5 people that magic question. If I could show you how to pay off all your debt and 2 to 3 times faster than what you typically would be doing it, would you want to know more about it? And we had some people say, yes, I'd like to know more. What's the next step?
The next step will be to get them to see the webinar so that they can understand. So we want to get the education out there first, because we're not selling the product. We want to educate them first, and then we lead to them letting us know if they want to move on. So after they see that, then they will book a time, on your calendar.
When is the webinar?
So right now I'm doing it different, Darren. I am setting it up to where my webinar will be like it's going live, where people can actually just click on it. And I'm not doing them singly every Tuesday and every Saturday like that.
Okay.
So I'm going to be doing that. I can actually give them the link and they can just look at the webinar, but everybody gets they're going to get that form back. And that's how you know if they're serious. If you get that form back, because you can't do anything without them filling out that Debt Free Life form. Okay, so we go out today. We ask that magic question. What do we have that form, or do we have a webinar? Do you have that ready today, or should we wait until you're ready to get that out to us? I can get that out to you. It should be by tomorrow, because my VA is actually working on something for me. If you'll put it in, send it to me, and Lindsay will help me if I need help, and we'll get it put in resources on our so we got our GroupMe page, but we actually, Lindsay added a resources page. We're going to put that in the resources page hopefully by tomorrow or the next day. And so when you find that client, you're gonna go to the resources, and we're going to put that webinar and the forms in there where they'll fill out the form. And once they fill out the form, they're serious, because they've got to put in all their debt stuff on that form.
and that's how we know you got one on the hook. You're ready to go, and we'll set that meeting up. Okay, and Helen can work with us on that. Okay,
Okay.
fair
Yes.
enough.
Big Red, yes, the underwriting is strict, so they're going to go through everything. And to give you an example, when I got my bank, I was running back and forth to specialists, getting the paperwork, sending it to them. They're gonna want, if they see something, they're gonna ask for those reports. So it's fully underwritten, and they want to make sure because these are big policies.
Mhm.
So don't think that a person cannot get approved, because that's what I was thinking before, which is why I did my bank on my husband. And I was like, let me try it for myself. So now I have a bank on my husband and a bank on myself. But it just took me about almost 2 months to get all of the information to them. So yes, the underwriting is strict. They're going to keep asking for things. If they see it, they're going to want to know why you was taking a medication, if it comes up. So yes, it's very strict.
But we talked about strict and underwriting. Fully underwritten is not a bad thing. It's got a bad reputation in life insurance because it takes so long and sometimes you don't get paid or whatever. But the reality is, I have got people that got declined with simplified issue. They weren't going to get it. Trish remembers one that we did one on, and they were got declined by about 7 or 8 different things. I said, well, let's go fully underwritten. They did the blood work on them, and then they gave them a lower rating. But guess what? The guy got insurance. He was unable to get insurance before. He just got a lower table rating. But so sometimes it takes a little bit more time. But you know what? We can probably get people. I had a lady that had a stroke 2 years ago. Well, you go, no, you're not going to get a term policy if you had a stroke 2 years ago. I went ahead and called National Life, and they said, well, send it in. We'll call the doctor and find out about it. What it was, she was thrown from a horse, and she's in Oklahoma, and that happens. And she was thrown from a horse. She had a blood clot, and the blood clot caused a stroke. Well, the doctor said it was a freak, kind of a freak deal, had because of this, and they went ahead and offered her a standard rating life insurance because they asked the questions. So don't be afraid of fully underwritten. Sometimes the fully underwritten can be your friend in this industry. So, all right, guys, great stuff. Good job to Helen. Thank you so much, girl. That's why we call you the queen, and you're always on top of it. We appreciate you. And we will get that information over into our resources. We're going to hopefully send you some clients. And if you guys, my suggestion would be send at least one her way so that you can learn the process. And then if you want to learn, you really take a lot of notes and then get with us. We'll teach you. We'll show you how to get Agency Rocket, how to do that on your own. And then you become that same subject matter expert. We're all capable of doing it. We just have to start somewhere. So thank you for this call. We got the VCC going on today. I want you guys to jump in there. And I'm going to be calling Foresters for you, Helen. We got to get that contract in place. And I'm going to work on that, okay? So love you guys, and we will see you tomorrow at 11 o'clock. We have our training with health and the new era. So don't want to miss it. I'll see you guys around.